So that way, whenever you do decide to pull that trigger on that first options contract, at least you go into it with a plan in place. Welcome back to Broke Man Finance. My name is Adam. I get asked all the time, almost daily, about how to do options, especially on Robinhood. A lot of people have heard about options, but they don't quite know what they are and what exactly they're looking at when they look at an options chain. But they have heard that they can earn a passive income by doing options, which is completely true. But it can be very daunting, and it can look overwhelming and seem a bit sketchy. I get it. I completely understand. I felt the same way the first time I looked at an options chain. But it's really not as confusing as you may think once you understand exactly what you're looking at. In fact, a lot of people earn an income and grow their portfolio passively by just getting those premiums. And if you don't know what that means, stick around and you will. Now, it may take you a couple times of watching videos like this. Feel free to go watch other ones like JJ Bugner, Brad Finn. There's lots of good videos out there, great content. Or it may just take you a couple times of actually doing a contract and just pulling the trigger on it and taking that chance until you feel comfortable about it. It took me a little while to get my head wrapped around it because, well, I drink a lot and I have a small brain. So in this video, I'm going to try to explain it and break it down in a way that if my small, drunken brain can understand it, so can you. Plus, I'm going to show you an easy strategy to go into trading options with, so that way whenever you do decide to pull that trigger on that first options contract, at least you go into it with a plan in place. Now remember, this is a very entry-level video, just to get the feet wet kind of video. We're not going to get into anything overly complicated. We're not going to get into any kind of candlestick strategies. This is not the video for that. If that's something that you can appreciate and or you get anything whatsoever out of the video, then do me a solid and smash that like button and don't forget to subscribe. Now, the dates and prices are probably going to be off because this was previously filmed, but nothing in regard to the options has changed. It all works the exact same way. But first things first, pull up a stock and make sure you see that options tab. It should say trade options. If you don't see it, make sure you have your options on and enabled in your settings. All right, once you have that done, now we can get started. I'm on AT&T, a very popular stock. I'm going to go and hit trade options. Now, this is going to pull up a lot of stuff, and like I mentioned earlier, you may need to watch this twice because I'm going to try to cover everything, but I'm trying my best not to throw too much at you at one time. So there's going to be some things I don't go over, and I promise to go over those things later. But right now, I'm going to try to hit you with the high points. Okay, so this is what they call an options chain. If you hear that term, it's just a list. It's just a list of contracts. Each one of these things represents one contract. Now, you have to remember that each contract sells in increments of 100. So you have to multiply each of these things by 100. Whether you're buying or you're selling. So this is going to be what you are. Are you a buyer or are you a seller? Today we are a seller. We're not going to be selling calls. We're going to be selling puts. This particular options chain is going to be expiring on August 21st. And when I pull it up, you can see that it has weekly contracts. Now, each company stock is going to be different. So some may trade quarterly, some may trade weekly, some may trade monthly, some may not have options at all on Robinhood. A lot of that is going to be due to the volume in which the stock trades. You will notice on the right is what we call premium. That's what I'm after. I'm here to collect premiums and get out. As I mentioned earlier, everything is multiplied by 100, so these are going to be multiplied by 100 as well. So this is what it means. The closer they are to the share price, the higher these are because there's more of a chance of getting assigned that contract and that contract getting exercised. So this 27 cents right here isn't 27 cents, it is $27. And as soon as I get this contract and it gets picked up, I earn $27 of credit. You can do whatever you want to with the money. You can reinvest it. You can go get Food, it doesn't matter. That $27 is now mine, regardless of what happens. So once you pick a contract, you click on it, you sell it, all right, it gets filled. That contract is going to show up above your other stocks on that home page. It's going to have its own little box that says options. Now that premium that you just got that we're talking about is going to go directly into your buying power automatically. And once that's in there, it's done. You now have that premium. It's gone from the buyer. Come that expiration date, depending on which one you pick, come that expiration date, if that share price is nowhere near that strike price, I mean, it can be near it, but as long as it's not at that strike price and it's not going to execute, the contract will literally disappear from that homepage. That little box I'm talking about where you will find it above your stocks, it goes away. And you still have that premium. That's the beauty of it. Now, you can buy yourself out of that contract prior to the expiration date, but we'll save that for another video. The seller, remember this, the seller of these is going to be collecting the premiums. That's the credit you're getting. The buyer is paying that for these contracts. Okay? So you're selling, and this is what it took me a while to get my head wrapped around, because I'm putting up collateral to earn the premium. So I'm selling a contract even though I'm putting up money for it. Okay? So let's talk about that. So the amount of money I have to put up is this. So let's stay with this one. Let's stay with this $29 strike price. That means that AT&T right now is trading for $30.01. It's the weekend, so the market's not open. Otherwise, you would see this right here continuing to fluctuate as you would these strike prices and percentages. All this stuff would always be moving around just about. But let's say you know what, you think that there's no way AT&T is going to go to $29 by August 21st. In fact, you think that AT&T is going to go up. You say, I want to buy or I want to sell this contract and collect that $5 premium. You got the money in there. There's the $3,100. I have the money. But so I'm going to have to front $2,900 or as collateral. And so I either have to have the funds available, or I'm going to have to do it naked, meaning I'm going to have to do it on margin. And your brokerage, whoever it is, like here, it would be Robinhood, obviously, would basically front me $2,900. They will determine my margin amount based off the value of my portfolio. It's not like you will have $500 in your portfolio and they're going to give you access to $25,000. That's not the way it's going to work. But if you have $25,000 in your portfolio, there's a good chance they're going to give you a pretty good percentage of that to play with. For the record, I'm not suggesting or encouraging in any way that you should play with margin. There is a lot of risk to that. But so you know, Robinhood charges 2.5% interest on whatever margin you use, which you have to be a gold member to get margin, which is a $5 subscription fee. And I'm pretty sure the interest on your first $1,000 is still covered by that $5 subscription fee. However, if you do decide to take the chance and use margin, you could at least look for some higher dividend paying stocks to do options on. So that way, if it does get assigned and all of a sudden you find yourself holding 100 shares of something, at least you would have a decent dividend coming in to help cover that interest rate. If you sell 2 contracts, like right here, if I wanted to buy 2 contracts of this, I would need that times 200. I would get $10 in premium instead of just that $5. The farther you get away from that share price, you will notice that premium going down, because there's less risk of that contract getting assigned to you. So let's go all the way to $25. But the chances of AT&T going to $25 by August 21st is pretty dang low, right? I mean, look at the chances right here of profit. You look at that, times that by 100, that's a $1 contract. And in fact, there may not even be anybody that picks that up, because the chances of that even getting exercised is pretty slim to none. Something pretty significant would have to happen for AT&T to drop $5. Okay, so but you understand kind of the concept of why. Now on the opposite end of that, if you look at this one, okay, $30. Right now it's at $30.01, so the chances of it hitting $30 is pretty significant. In fact, it would probably need to be closer to this for it to get exercised, because the buyer that's putting up the money for this contract is going to want to get that money back.
So that's why when you see this 27 cents right here, take that away from that and you have this. That's the break-even price. So realistically, that strike price at 30, it can be exercised at 30, that's what you agree to, but the chances are it'll be closer to this when it actually gets exercised and you pick up 100 shares of AT&T. So you may be thinking, well, $5 isn't that much for $2,900 collateral. That's true. And a lot of times these premiums are going to be based off the volatility of that stock. Now, AT&T, for the most part, is pretty stable. They have some fluctuations daily, but for the most part, they don't have huge swings in the market. So let me show you what I mean. AT&T 3001, you seen what these premium prices are for these strike prices? Let's type in Workhorse. So Workhorse is trading for about $15 a share, $15.24. All right, remember, we're going to go up here, sell a put. They also have, let's see, they have weekly options. But you can see here, this is where we were floating around with AT&T. You can look over here, $28, $45, $63. But the chances of those fluctuations in share cost are much, much greater in a speculative stock like Workhorse. It's much more volatile. And you can see that implied volatility right here is 92% as opposed to the same place in the options chain with AT&T. I believe it was like 22%. But that's why you're going to earn more premium. And that's literally half the cost, less than half the cost of what the AT&T was. But it's 6 times the premium.
Where people mess up is they get greedy. Stable companies with little volatility like Coke, they're not going to offer much premium. So people like to just disregard them. Risky and speculative plays offer very tempting premiums with very little money up front. So it's very easy to get in that trap of chasing that premium, and all of a sudden you get several contracts exercised against you, and now you're holding 300, 400 shares of a company that you really didn't want in the first place. You were just wanting that premium. There are a lot of people holding bags out there right now because of that very thing. So you have to be smart and make good decisions. Otherwise, you could get caught in that trap as well.
For me, I started out getting small contracts and earning smaller premiums, but that was just less volatile, so there was less risk. And I've slowly started to grow my portfolio over time. So let's look at AbbVie. AbbVie is one of my favorite stocks. So if I was going to sell a put, now we're going to need $9,500 worth of premium. It's not a really crazy volatile stock, but you can see the share price, or you can see the premium prices are going up. Let's look at Facebook. As your portfolio continues to grow, you can start looking at more options, like more expensive stocks, like a Facebook, $260 a share. So you go through here and you start seeing the potential. $390, $296, $217. All right, let's go to Apple before the split. $410, $287, $198, $588, almost $600. Let's say you're really moving and grooving. Let's go to Amazon. Let's say you have $400K in your account. This is how the rich get richer. One contract, $4,400, $4,100, $3,600, $3,300, $2,800. Now, are you putting up a lot of money? Oh, hell yeah. But look at the return you're getting for not doing anything.
My number one rule is this when it comes to options. Only do contracts on companies that you don't mind owning 100 shares of. If you don't really want to own the company, don't do contracts on it. Or if you're wanting to buy 100 shares of something anyway, you could sell a put against it with a strike price near that share price. Hopefully it gets executed, and at the same time you earned a little bit of premium in the process. So you get 100 shares of the company that you were wanting, and at the same time that premium helps drive that overall cost basis down.
If you're just chasing premiums and you don't know anything about the company, you're not well aware of the movement of that share price, and it's not a company that you really want to own, leave it alone. Don't mess with it. So if I bought this, whenever I was buying these contracts for the AT&T, it was fine. I was good with having AT&T. They have a great dividend, and if I do get assigned, okay, well, now I'm just going to sell a call against it, hopefully for a price higher than what I was assigned at, and I'm going to earn that premium plus that dividend and plus those capital gains. Easy peasy.
That's the wheel strategy. You sell a put, you earn that premium, but let's say that share price drops to your strike price, boom, it gets assigned. And now you own 100 shares of whatever stock. No worries. Hopefully it didn't drop too far. But now what you're going to do, you're going to turn around and you're going to sell a call against that. And you're going to use those 100 shares that you now own as the collateral as opposed to putting up that money. It works the same way, but opposed to looking down that options chain at those strike prices, now we're moving up. You find a strike price above what you originally paid, and if it gets assigned, fantastic. And now you've made some capital gains, and you can start selling puts against it immediately. Plus, if a dividend is offered, you can earn that while you're holding on to those 100 shares. Now, let's say that the contract expires and it doesn't get assigned and you're still holding the 100 shares. Fine. It works the same way. You're still collecting that premium. Now you've got a lower overall cost average. The cost basis has dropped some since you collected that premium. You're going to recycle and do the same thing over again. And like I mentioned about the dividends, you're still earning that. And if it gets assigned, fine. Now you're just turning back around and selling puts against it. And it goes round and round. That's the wheel strategy.
And if you're comfortable with doing some more risky stocks, then fine. And then if it's something that you know about, hey, no problem. Maybe your portfolio is big enough that you could just go ahead and start doing more expensive stocks. It's all good, but the main thing is, for me, is I'm going to collect that premium. So let's review. So what we did here today, we sold a put because we believe the share price is going to go up. So what we want to do is find a strike price we're comfortable with that we don't believe that the share price is going to get to by the expiration date. And by doing that, we earn $5 of credit, or 11 or 27, or wherever we feel comfortable. And there's pretty much an 89% chance it's not going to happen. The break-even price, remember, is a price that's got to get to so that buyer can earn back the money that they front, because we're sellers, so we're collecting premium. If we were buyers, we would be putting up that premium. If it gets assigned to us, fine, because we never sell puts against companies we are not comfortable with owning 100 shares of. If it does get assigned, no big deal, because then we go and we just start selling calls against it. We're going to earn some capital gains, we're going to earn some more premium, and we're going to earn some more dividends. And then as soon as that 100 shares gets assigned and that contract gets exercised, then we're back to selling puts. And so as our portfolio grows, we have more option opportunities with higher price shared companies like an Apple or Facebook.
I hope that all made sense. If not, let me know your questions in the comment section below. Let me know also if you like this kind of content. I'll make sure to bring some more videos regarding options. As always, best of luck with any options contracts that you guys decide to do. And I hope all your stocks go to the moon. See you next time.